Hello guys, this is ObaFX Trading Academy and welcome once again to my YouTube channel where we do the top-down analysis of different financial securities. And today we're going to be looking at a Deriv synthetic index volatility 751S index. As you all know, I do my analysis using pure price action trading strategy, and currently I'm on the monthly time frame. So let's look at what this particular index has for us. So mainly looking at our charts, we can see that if we were to look at the most recent portion of this chart, which is this place, it's very easy to see from this sea of red candles that this particular index has been on the downward trajectory. Of course, you all know that what we try to get from the monthly time frame, we get our directional bias. On the weekly time frame, we look for a structure of the market or a chart pattern presented by the market to work with. I call the daily time frame the tradable time frame. And of course, from the hourly time frames or the minute time frame, we try to take our entries. So the first thing that we can deduce so easily from this particular time frame, which is a monthly time frame, is that the market is in a downtrend. So how do we mean? The market made a lower low, a lower high, a lower low, a lower high, and it's currently heading downward. So bearing this in mind, our directional bias is downward. So we'll be hoping to get um, selling opportunities from the market. So the next thing would be to go to the weekly time frame. And like I said, we try to get the structure of the market to work with on this particular time frame. And how do we do that? First, to make this a bit easier for me, I go to the line graph. So now from the line graph, I can see the regular and popular bearish chart pattern. Now, what do I mean by the regular and popular bearish chart pattern? It's this particular pattern where we have the price coming downwards, does a pullback, continues downwards. So the market makes like from a high, it gives us a low, then a higher low, or rather a lower high, and then lower low. And then from what we can see on the chart, the market is currently doing this. So this is what we just succeeded in drawing, this pattern. A retracement, and then we can see that price is being pushed downwards gradually. So if I'm to take this out, this is the pattern of the market that we're working with. And the easy way to trade this is to wait for price to come back into the zone, and then we can start looking for selling opportunities. And from what we can see here, the market already did that, came down, pulled back up, came down, did its retracement, and we can see these two bearish candles trying to usher in the sellers again for the market to continue in its downwards direction. So this aligns with our take from the monthly time frame that the market is heading downwards. So we now have to look for a way to bring in our regular tools, which I use in my analysis. And of course, as you all know, I use mainly the support and resistance zones, the trend line, and the Fibonacci retracement tool. So if I'm to include the very first of these, I'll take my trend line and place it here. So as you can see, we have even more than 3 touches of the trend line already. So the next thing to do would be to take my Fib2 from the most recent swing high to where the market started retracing upwards from. And of course, for those that have been following my analysis, I have what I call the Fibonacci retracement tool golden zone, which is the zone between the 50% and 61.8% mark. So with the hope that once price gets back into the zone, then we can look forward our sell opportunity. And from what we can see already, from this green candle, price retraced and touched the zone. So you can see, like I said earlier, the market already heading downwards. So we have to go to the what I call the tradable time frame, the daily time frame, to see if we can still catch any opportunities. Because as we can see, the market momentum of the market downwards is still not so strong that makes that we can deem it too late for us to get selling opportunities, because we can still see that the market will be heading downwards. So on the daily time frame, the chart becomes a bit clearer, the sense that we can see that from the retracement, the market came into briefly into our golden zone, Fibonacci retracement golden zone, made another touch of the trend line, and the market is currently heading downwards. Taking me to my popular question, which is how do we now take advantage of this setup? So to take advantage of this setup, we have to go to the hourly time frame to see if we can get possible to see how we can get possible entry into this market. So we go to the H4 time frame. Now on the H4 time frame, one of the popular entry models I use in taking trades from the market is to employ what I call the counter trend line. So the counter trend line is actually a trend line that goes in the opposite direction of the original trend line. We've established that this is a bearish market. The market is in bearish trend, so our counter trend will be moving in the bullish direction. So why is this like a very simple entry model? All we need to do now would be to patiently wait for the market to break completely beneath this trend line. So what I'm trying to say is, for me to jump into this trade, I'll have to wait for the 4-hour candlestick to completely close beyond or beneath this counter trend line. Once there's a retracement back to it, then I can start looking for my sell trades. So even if I'm to go down to the 1-hour time frame, we'll see that it's still going to be the same thing. So this trade is still very, very much valid. Of course, you know that you can trade synthetic indices even in the weekend, and today is Friday. So you can watch this particular setup for both Saturday and Sunday, including today. So once we're able to get a break of this counter trend line, and there's a retest, then we can jump into this trade and can probably then you can have your stop loss here just above this level, and your first take profit will be down here. So you can see that if you are to look at the distance from this place to this place, this is going to give you a very, very nice risk to reward. So this is what I have for us today regarding top-down analysis. We've looked at volatility 75-1S index. So like I always say, you can compare this with your own analysis if you're into the trading of Deriv synthetic indices. If you don't have a Deriv account, you can use the link attached to the description of this video. So and also, if you think that you've gained anything by viewing this particular video, it's only fair that you click on the like button, share with others to gain from it as well. And if you want to get to be the first to see subsequent top-down analysis videos like this, you can subscribe to the channel and turn on your notification. Thank you for stopping by my channel, and enjoy the rest of your day. Cheers.